ended the last video by saying that the simple transaction process which Amazon engineered is the reason for the excellent performance of the Amazon business model that Jeff Bezos created. Well, according to Professor Mihir Desai of the Harvard Business School, the key to really understanding the Amazon model for generating cash is to pay attention to the Amazon cash conversion cycle. And the cash conversion cycle, or CCC, according to Professor Desai, is defined as follows: days of inventory plus days sales outstanding. In other words, CCC tells the manager how long it takes the customer to pay minus how many days it takes us to pay our suppliers, who are the publishers or product producers, etc., in the case of Amazon. Well, now you might be wondering, how does Amazon cash flow management compare with other major retailers like Walmart or Costco, the membership warehouse company? Well, that's a good question. For comparison purposes, Walmart and Costco have a single-digit CCC, which is quite impressive for a retailer. But Amazon has a CCC of around minus 30 days, and that CCC figure is just unbelievable. And it's unbelievable because very few companies can achieve those negative CCC levels. As a matter of fact, other than Apple Computer Company, who have a CCC of around minus 44 days, very few companies are able to achieve double-digit negative CCCs. And what a CCC of minus 33 days or more means is that Apple and Amazon are cash machines. They're generating cash rapidly, and that's the secret to Amazon's success. And in the case of Amazon, all of that excess cash is used to finance the growth of the business, because growth is considered to be the real value of Amazon according to the management. And an added bonus for Amazon is that because of this remarkable CCC, Amazon don't need to borrow money from the marketplace at high rates of interest. Plus, they don't need to issue more stocks or equity in order to raise money. So this means that Amazon can keep using their cash to develop new businesses and upgrade their current offerings. And Professor Desai at the Harvard Business School would describe Amazon as an excellent case of a company that has an economically fine-tuned engine which effectively serves Amazon's strategic goals in a really interesting and thoughtful way, as long as the future investments made by Amazon management will pay off. And one important point to pay attention to here is that excessive free cash flow at Amazon makes it possible to experiment with new ideas, learn from mistakes, keep moving ahead regardless of what shareholders think. And in the Amazon cash flow model, great inventory management also matters a lot. So you might be wondering, how great is Amazon at inventory management? And that's another good question. Well, to understand better how Amazon perform on inventory management, we first need to understand the concept of inventory velocity. And inventory velocity is determined by the point when Amazon collects cash from the customer compared to the point when they pay suppliers for their products. Based on this inventory velocity calculation, Amazon, in fact, is not an inventory velocity champion. As a matter of fact, Walmart and Amazon have almost the same inventory velocity rate. And Costco, the warehouse club, turns its inventory much faster than Amazon or Walmart. And in addition to this point, customers pay Walmart and Costco a little bit faster than Amazon customers pay. But here is the key point which makes this fact less important, and pay attention to this trick. The secret weapon for Amazon is that they take a very long time to pay their suppliers. In fact, Amazon takes almost 97 days on average to pay suppliers. This could be compared to something like 38 days for Walmart and 30 days for Costco. Well, 97 days payment terms with suppliers is amazing, and many observers are wondering, how long can they do that? How long can suppliers put up with that. Well, we should not also forget that the business model at Amazon is very dependent upon growth. And this means that growth is a critical question to consider for management and how to continue growing. So what is the growth potential for Amazon, you might be wondering? And the answer to the question of what is the growth potential for Amazon can be better understood by looking at the retail sector in general. And Amazon currently have about 1 or 2% of the total US retail market in terms of value. So based just on that low figure, there's apparently considerable scope for growth, even in their existing markets. Now, Jeff Bezos, the founder and CEO of Amazon and the third richest person in the world, also seems to have a pretty clear view on what he is planning to do with Amazon, which includes 1, continuing to identify new growth business opportunities, 2, continuing to reinvest the profits into the business, and 3, continuing to use every single last penny in order to do that. Wow, again. That was a short session, but we covered many of the most important finance principles which are most useful to managers. So what are the 3 lessons you should leave this finance session with? The first and most important lesson is the principle of value. And the principle of value in our definition says that excellent strategy and management are essential to creating value. Market expectations do have an impact on value, but value creation means more than just market expectations. Managers must work towards achieving a rate of return greater than the cost of money needed to fund the growth of a business. And maximizing cash flow is one important way to get cash for funding the future growth of any business. The second important lesson from this session has to do with free cash flow. And free cash flow can be improved by getting your customers to pay quickly, taking as much time as possible to pay your suppliers. By following this rule, your company's free cash flow will be, even if the net income is not positive, your cash flow will be very good. And the third and final lesson from this session is that by generating healthy free cash flow, the more the merrier. It's possible for you to experiment in your business, learn from your mistakes, even if they're costly, and keep moving ahead as the value of your business continues to grow. In other words, free cash flow gives you the opportunity to invest in your business as growth continues, and the investments encourage growth, and the result of those investments, you will increase the value of your business. But now let me give you some bad news. Throughout this discussion, the overriding assumption has been made that most companies are investing for the future. But in fact, the data shows us that this is not the case. And according to Professor William Lazonik of the University of Massachusetts, who has researched this subject, instead of creating value for their firms, the shareholders and society, top executives of firms, through the massive use of shareholder buybacks and doing the opposite, are not creating value in the business. In fact, they're extracting value from the businesses. And Professor Lesnick has discovered in his research that between the year 2003 and 2012, publicly listed firms on the United States S&P 500 index, the S&P includes the 500 largest companies in the U.S. Well, Professor Lesnick discovered that between 2003 and 2012, those firms used 94% of their profits, or $2.4 trillion, to buy back their own stock, pay out dividends, and pay compensation to executives. In other words, those transactions transferred large profits to shareholder activists. In fact, what this means is that 94% of the profits of those companies added no gain to the companies themselves. 6% was reinvested into business. Professor Lasnonik points out that this practice has not always been like that. For example, in 1945 to 1970, the dominant approach by companies was to retain profits and to reinvest those profits into their business. In other words, during that period, firms retained earnings and reinvested them to increase their capabilities. But from the 70s onward to the present day, the focus by a lot of companies has been on reducing costs and distributing the freed up cash to financial interest, in particular shareholders. And Professor Lazonik says the root cause of this problem is the philosophy of maximizing shareholder value. And he says this because with 94% of earnings going to share buybacks and dividends, there's only 6% of the profits left to reinvest for the future of those businesses. So bootcamp participants, please be aware of the realities of how markets really work. And we might end even by saying that irrationality, after all, is not in short supply, especially if we consider the future viability of every business.